Welcome back to All Things Money. I'm David Blain. Before the break, we were taking a look at the unemployment situation as well as the prospects for our economic recovery. And we talked about we feel the economy is going to experience what we call a square root recovery, but unemployment is going to remain elevated for several years. And we talked about the increases in productivity, the growth in the labor market, as well as the cautious outlook of many companies today is going to keep that unemployment rate high. Another casualty of unemployment is what we call the PCE, or personal consumption expenditures. And the PCE measures price changes in consumer goods and services. These are things that are specifically targeted to individuals and consumed by individuals. Of course, you have all sorts of different measures, inflation rates, which we'll talk about in a little bit, but the PCE's, personal consumption expenditures, are specifically targeted at individuals. And we see here we're predicting that the personal consumption expenditures are going to be lower than normal. A couple of reasons for that. Wage growth has been pressured by this excess supply in labor. And so the people that do have jobs, they're not going to see tremendous increases in their wages. If you're an employer and there's 10 people standing outside your door that have no job, that would like a job, and you have a person that is employed currently, well, you're not going to give that person a large raise when you know that you could go outside and hire one of the 10 people waiting in line for that job that would take less. So high unemployment keeps wage growth down. The other thing that's happening is that we're seeing a lot more compensation come in the form of benefits versus wages. That a lot of times benefits can be given to an individual at a much more lower cost. For example, certain benefits such as health care. If you give an employee health care, the employer does not have to pay Social Security, Medicare on that. They don't have to pay unemployment insurance on that. So by giving a benefit, the true cost to the employer sometimes can be lowered by 10% or more. And so it's much more advantageous to give a benefit to the employee than to give them a raise for a lot of things. The PCE is also going to remain low because the savings rate of individuals is already low. We saw a little bit of a spike towards the end of 2008, the beginning of 2009, but essentially the savings rate is back down to very low rates already, which means that the consumers are already spending the majority of the money that they have, and so there's no way to ramp up their spending because they're not saving anything to begin with. In the past, what they would do, the consumer would go out and borrow this money and leverage up. Well, we are seeing the consumer a little bit more reluctant to leverage. We are seeing some deleveraging by the individual, certainly not deleveraging as a whole. The government is leveraging up. Companies are deleveraging maybe a little bit, but in certain areas they're taking on more debt. But the consumer, it seems is deleveraging a little bit, which once again is a negative for the personal consumption expenditures. And the other thing is simply demographics. When the population is aging, personal consumption on everything except for health care tends to go down. And so we see that the demographics are negative for personal consumption expenditures. One thing that we look at also is the risk of deflation is actually increasing. We'll take a look at the deflation equation here, but previously, if you followed the show, I've been very concerned about inflation, and I still am in the long term, but we've pretty much backed off of that in the short to intermediate term, and we don't think inflation is going to be a problem. In fact, we're possibly worrying about deflation. When I look at previously at unemployment and companies leery about expanding and hiring, the less availability of credit and decreased spending are the two main features of deflation, and we saw that in the The Great Depression actually had periods of deflation when there's not a lot of spending going on and you have the contraction of credit. It tends to lead to deflation. Currently, we're not in deflation, but we're in very, very low inflationary environment, which is very good for the stock market. We think it doesn't look like the Fed will raise its rates anytime soon. The reason for that, the unemployment rate, the inflation rate remains low. The Fed does not like to raise rates if inflation is too low. There's not, strictly speaking, an asset bubble, although some people would argue that the stocks are back in an asset bubble. The banking system is not completely restored to health, and so the banks rely on very low interest rates to borrow money from the Fed, which they can turn around and loan to consumers to help shore up their financial stability. And if the Fed were to start raising rates prematurely, it could have a very negative effect on the markets. Simply, Ben Bernanke, the chairman of the Federal Reserve, has vowed not to repeat the mistakes of the 1930s. And one of the mistakes of the 1930s, most people think, was that they started raising rates too fast and too early, and it caused the depression to continue. And they're also concerned about a reemergence of stress in the financial system. So we see that personal consumption expenditures will remain under pressure, keeping that down. We think that deflation is actually a slightly larger risk in the short term, but we don't see the Fed raising rates anytime soon. That takes us to our next break. For All Things Money, this is David Blain.